ODR, 4 weeks, 1 pair. It's the last results I showcased about the 5 steps. Today, we're going to be doing something different. I'll be showing you the trades that I executed in the past few weeks through a demo account that I consider my challenge. And you may ask, why didn't I take a challenge? And it's simply because I started this in December, around the end of the year, so I prefer not to run the risk of any market instability or anything close or related to that could put in risk my capital. But I utilized this demo account, as if it was my challenge, to see how I do. These are the results based on approximately the past 3 weeks. 10.88 are taken, but the funny thing is that I missed on many really good opportunities, which is impressive, really, being that even though I missed out on as much as I did, I still be up as much as I am. But first, let's hear about a sponsor. Chart Prime. Chart Prime is a trading suite that facilitates certain tasks that a trader usually goes through, just like you and me, by providing top-of-the-line and unique trading indicators that automate the technical analysis, offering multiple tools that allow the trader to save some hours of work, while an automated indicator detects patterns to let the trader know there might be an opportunity showing up. It's not buy and sell indicators. Their software simply automates part of the analysis. Unbelievably enough, they're even offering one-on-one coaching for you to understand and learn the basics of trading while utilizing their tools. Chart Prime is also offering quite a not to miss out opportunity with a huge discount for everyone here. You can try Chart Prime through this link, which is also on the description box. Thanks for Chart Prime for their awesome indicators and sponsoring this video. Now, let me tell you why this video goes first, and why is it important. I'm showing you why I truly believe the 5 steps can be a really good way of trading. A, between quotes, simple way of trading. And I need to clarify that strongly. Because trading is not simple, and the psychological part of it is always going to be quite hard. However, understanding the concepts that I use, and then looking for these series of steps, believe me, it's not that difficult. So these are the trades taken on my challenge. Let's see how they happened. I want you to see the 5 steps without me having to tell you where they are, and then let me know if each trade had the 5 steps or not. So the first trade that I took with this challenge account is this one, right? Let's see how it went and why it failed. If we go over to snapshots, now we don't need to go to snapshots. Let's look at the higher time frame structure. Can you see something clear why this trade could have failed specifically? I'm gonna give you a second. But no. There's no reason for this one to fail. Not necessarily no reason for it to fail. It does take buys liquidity from this couple of equal highs, and then it reacts to it, right? Maybe that's a way that we could have avoided this loss. Now, do we have the 5 steps? From the higher time frames, we have the steps that we have to find there, which is the run and sell liquidity, which actually we don't have only one low. We have 3 equal lows, basically a lot of sell liquidity being built up and taken on this move lower. Now, what do we wait for after that run and sell liquidity is an aggressive move higher that creates fair value gaps and causes a market shift. Market shift happens all the way up here. Fair value gap, we have one down there and another one in the middle, right? This one is the best one because it's at somewhat discounted prices or equilibrium prices. And then this one will be the ideal case due to the fact that it's much lower. Now, looking at the lower time frames, can you see something that is out of the ordinary or not based on the 5 steps? I'm gonna give you a second again. But there's nothing out of the ordinary except the fact that, well, the market shift on the 1 minute is a little bit complicated, right? If we were to analyze this a little bit further, we do have a swing high. It is a swing high, and I personally, on the lower time frame and in the higher time frame, what I look for is for the market shift has to be a swing high or a swing low. Being a swing, a pattern of 3 candles, right? Probably we're all aware of what a swing high or a swing low is. So the market shift is the only thing that was a little bit weak, but a valid market shift overall. At least that's the way that I saw it and that I see it. Also, this was a little bit weird, a little bit not ordinary per se, but at the same time, it's still the 5 steps reason why, in my opinion, this was a no-brainer to take, and I participated on it without any kind of hesitation. It doesn't work out, and it is what it is. Now, what do we have here? Do we have the 5 steps? Yes, they happen in a clear way. In my opinion, they did. The only problem would have been the lower time frames. That's really pretty much it about this one. 1% loss, 1 hour loss, nothing for us to do. Now let's move on to the next one. Second trade that I took on this challenge was a GBP dollar with the 5 steps long trade that ended up in 2.18R. Now there's something that I want you to see. This risk reward ratio here, and average, I'm actually going for just 2R. That's something that we're going to see repeated a lot. And I want you to keep in mind that I kind of want to say in every case except literally one, price does get to at least 3R, which is what I like going for. But every single trade was closed at 2, or, well, actually we have one at 2.87R there that we'll talk about as well. But basically, most of these are closed at 2R, and still I managed to get 10R. We'll talk about what we could have gotten at the end. Let's look at this GBP dollar trade. Obviously, going for the 5 steps, or the higher time frame steps, I want you to see how this one is a little bit of a complicated one. Because if we look at the higher time frames, the 5 minute, first of all, we have a pretty bearish trend, right? Very bearish trend. So the bare minimum structure that we get has the 5 steps, so I decided to take it. And as you can see, even down here, we're getting a really minimum market shift on the 5 minute. It is a swing high. It is being broken by this tiny bit of a move above it, and then the immediately price trades back into this fair value gap, giving us the chance to look for lower time frame opportunities, of which we do, right? And what do we get? The exact same thing. Have a higher candle, a lower candle, higher candle, the market shift above that high, the fair value gap, and the execution. We have step 1, 2, 3, 4, and 5 all happening basically around the same time. And to be honest, the market shift was something really difficult to utilize, to consider as a market shift, and to actually risk this on this trade. And as you can see, the risk actually in this case is only of 0.5%, right? As you can see, out of 2.18R, I'm getting 1.27%. So a very good trade, risked a 0.5%. And also look at where I closed. Look at where it was closed and look at how far it actually pulls away. And even on the 5 minute, we can see how far it went. I closed around these levels, right? In price, we could have easily gone above this high. We could have gone for this fair value gap that we have here. We could have gone above this high, which is buys a liquidity. I don't think I would have gone further than this, but we're saying that we had the opportunity to take 6, 5, 4R, and I went happily for just the 2R. Just keep that in mind because we will be touching that subject later on. Let's go for the third one. Third trade that I took was a 2.87R being taken on euro dollar and 1% being risked. Let's look at the higher time frame first. And this was actually a really interesting trade because we have step 1, step 2, the fair value gap, and step 3 happening pretty late. To keep in mind, you can look at the times, and this structure is created at 5:35, 5:40 or something like that in the morning, which is basically 40-35 minutes after the London Kilson had ended. So the mitigation on that fair value gap happens at around 8 AM, pretty late. Why is it a valid entry? Because it's the 5 steps overall. I do have a hard time when price pulls away from an entry or a step 3 and then it comes back. In this case, I analyzed it. I liked it. I liked the fair value gap. The lower time frame entry was lovely in my opinion. And that's pretty much all that we had. Look at this entry. We're going to talk about 2 losses that happened in GBP dollar on Thursday, if I remember correctly, this week. And you'll see that this pattern repeats on a higher time frame, and that led for 2 losses. And we'll get over to that later in this video. So what do we look for in the lower time frame? First of all, the mitigation of the area, that's step 3. Second of all, we need a fair value gap and a market shift in the 1 minute. We get the market shift, we get the fair value gap, right? This first move, does it have a fair value gap? Yes. Does it have market shift? It doesn't, because there's no swing low being broken. Then this swing low is broken, right? Price trades through it. We have a fair value gap. That's exactly where we execute. What did I do here differently? The stop loss just above that high, just in the case price decided to play around these levels and take me out without just taking me out, right? Now, I want you to look at this trade. Does it look like this is a 2R trade? And there's something more interesting about this one. Sorry, a 3R trade. Does it look like this is 3R? Because it's not, of course. And there's something even more interesting about this one, because if we understand structure, if we're expecting price to be bearish, what are we supposedly expecting price to do? To create the lower low, right? If the bearish trend is going to be respected, we're looking for a lower low, a lower high, a lower low, a lower high, a lower low. So is it reasonable for us to be targeting this low? If that trend is going to be respected, then yes, it's definitely reasonable. Also back here, we have a high, then a lower low, right? By breaking this higher low, a lower high, a lower low, a lower high. All that we can expect is for price to do that. Now, personally, I don't use it that much because I prefer going for something a little bit safer or for 3R, 2R, and just be done with it. So what I'm trying to say here is I'm not sure, and I don't think, actually, maybe I did. Yes. So look at how far, look at where I exited. I had a 50% exit efficiency because price got all the way down there. I closed at a 3R when I could have taken a 6R trade. Or let's call it 5 because maybe I'm saying this wrongly, right? I might be mistaken about it, right? It's insane, this trade, right? And it's insane that I just took 3R. At the same time, I'm pretty happy with that 3R, right? I'm pretty happy with that 3R. So there you go. What repeated on this trade, just as it repeated on the loss and the previous win. Let me know about that. Let's move on to the fourth, right? Next one is apparently a loss of a 1% taken on GBP dollar, trying to go long. Oh, I do remember this entry. And what do we have here? This is actually something that, as an example, we could have avoided due to the simple fact that when the market, when the fair value gap is mitigated before the market shift, I tend to avoid that fair value gap. In this case, I didn't, and it actually fails. Now, I'm not saying that a fair value gap that is mitigated before a market shift is invalidated. But me personally, in my experience, I avoided those. In this case, I took it either way, and it actually ended up failing. Now, direction definitely helps, right? It's pretty bearish, and it was. We do not have too much information on this picture, but we did have a very bearish direction at this point. And when we go down to the 1 minute, it was also a little bit complicated because if we, this is the mitigation, it ranges for a little bit, causes a market shift either above this couple of highs or this high. And the fair value gap is finally here, right? Stop loss all the way down there. As you can see, aggressive move lower, reacts a little bit, kind of went back up into fair value gap 2 and continue going lower. How could we avoided this trade? First of all, bias due to price being as bullish as bearish as it was. It definitely had the opportunity to just look for buy side liquidity and then continue going lower. That was definitely something that we could have thought of. And second of all, due to the fair value gap being mitigated before the market shift happened. For me, looking back at it, the only reason why I would have avoided it is because of this, the fair value gap being mitigated before the market shift. Otherwise, the direction, as you know, I don't really look too much into lately, and it has been quite okay. So let's move on to the next one. Next one is a euro-dollar trade in which I closed at a 1.96R, and it gave me 1.71% profit, which means that I risked a 1%. So in this case, what do we have? Let's look at the higher time frames and tell me what you see. Okay, so small clarification about that one. Price does trade inside the fair value gap in the live market, but in the moment, not in the moment, and when I took the screenshot with the replay, it changed the wick, which means that basically this doesn't show us it triggered it. Basically, doesn't really matter. Again, it's random buys liquidity, aggressive move lower, market shift, trace back into a fair value gap inside the high and the low that caused the market shift, and in there we get the lower time frame entry. That, as you can see, what do we have here? Higher candle, the lower candle in the middle. Price breaks through that after causing step 3. So we get the market shift, which is part of step 4, and then the fair value gap, which is the other part of step 4, and that's the execution. When I look at these examples, I cannot think of any way of making it easier, right, to explain. Now, this was closed in and around these levels at a 2%, and we could have gone down to the 2.5 I think we had below that low, which means that definitely could have been a tiny bit of a better result, right? But again, it's not that much, right? Not that much, but definitely a beautiful trade, 2% basically taken. And nothing for me to say about that one, right? It's just the 5 steps, basically. Now we have a 0.5% risk on a Wednesday on euro-dollar, which this is the week in between Christmas and New Year's. And let's look at it, right? Let's look at what we have. Random buys of liquidity, market shift. And this is actually, I think, the trade that doesn't reach 3R. So round buys liquidity, market shift, and look at where it happens. This happens at London kills him. London just continues trading bearishly. Then what do we have in between 5 and 7, which is between basically London kills him and the beginning of New York kills him. Price basically slowly crawling back up onto the fair value gap, which in this case is step 3. Do keep in mind that we are in a 15-minute time frame in this case instead of a 5 minutes. Doesn't really matter, so as long as we have everything together, happening together, it doesn't matter how, or not how, but which time frame it is. What do we have? Price mitigates the fair value gap, run on a high, swing low, being broken as a market shift. That market shift gives us also a fair value gap on which price trades back into it right at the beginning of the New York kill zone. The mitigation could have not been at a better timing. And as you can see on this one, price just goes aggressively lower. I personally closed it at 2R. We could have gone below this low, which is 2.3, 2.2, something like that. And if we would have gone for 3R, price does turn around in this case. So this is the only one that I have taken on this challenge account that has actually not got into, at the very least, the 3R mark, right? I think, I'm not going to promise on that. We might get another example further in this video, and then I'll mention it. But at the time, I do believe that this was the only one of these trades that doesn't actually get to the 2R mark, right? To the 3R mark, sorry. Beautiful trade, the 5 steps as usual. Let's move on to the next one. This was a beautiful trade on GBP dollar, a 2R take profit with a 0.5% risk as well. And that ends up in a 0.86%, I think, not a large trade. So let's look at the higher time frame. This was a very massive bit of price action because price is ranging, as you can see. But what do we have? Round buys liquidity, a little bit of a range. Then I didn't actually draw it here, but this low goes below this couple of equal lows there, and immediately we see the aggression, right? What do we have? The market shift, the fair value gap, right? Price then trades back into it right there. And what do we have? Aggressively higher. The swing high, the market shift, the fair value gap on which we can execute. We could have executed lower, which we would have been missed out basically. And then price triggers us in and starts going aggressively higher. I didn't take a screenshot of this, so let me show you how it ended. So this is the trade on JP dollar, Thursday, December 29th. I'm going to ask you, where or how far do you think we could have gone with this trade? Right, looking at the direction like this. What do we have since the creation of this low, the creation of this high? We have a low, a high, a higher low, a higher high, a higher low. We're getting the confluences to buy down here, on which theoretically we have a higher low, and what is this theoretically? What is theoretically this, right? What is this theoretically? A higher low. So what can we expect or potentially expect price to do to get up to the higher high? Now, this would have been complicated, but at the same time, definitely not a break even. Because if we would have wanted to go above this high, we're getting exactly 3R, which is what I'd like going for. Now, that move lower would have been a hell, right? Because price gets really close to our stop loss. Now, here's the thing. Keep in mind that for us to be taken out on a break even, my stop loss will always be at the entry and 3 ticks higher. Why 3 ticks higher? To cover commissions. So 21 plus 3 is going to be 24. And as you can see, price theoretically triggers that level because it literally taps on it. Now, due to spreads, that is actually not true because price, when it's tapping this area, it actually, the ask or the bid price, I don't really care how it is. Thing is that spread is a little bit higher. So price has to actually trade a bit lower to actually trigger us out on that break even that we have. So even if this would have been a break even, I would have avoided that break even just due to spread, basically. But me personally, as you were able to see, close the 2R. Pretty happy with that. But again, this is another example that it could have easily reached the 3R mark without much of an issue, right? Let's move on to the next. This is not the one. On Tuesday, 3rd January. And as it is a break even, and I don't remember taking a break even, yes, it's one opportunity that I actually missed out on. And when I include those misses per se, there's a pretty big importance about them. So let's look at the higher chart first. A tiny round buys and sells the liquidity, which we also have this to the left. Clear string high being broken, which causes the market shift. A fair value gap, price trace back into it, and that's when we jump onto the 1 minute time frame right here, on which we see price trading back into the fair value gap, ranges, doesn't give us anything, goes aggressively lower, takes us the liquidity, doesn't give us anything, and then aggressive move higher, market shift, fair value gap, that's my entry, and price, as you can see, actually does not come back for the step 5. But here's the thing, it actually does, but it does it quite a bit later, right? So we have the fact that 52 minutes went by before the entry was triggered, right? Before my level was executed, or my entry was executed. And in those 52 minutes, we had the fact that price pulled away from our entry for 3R, which means that at that point, I would have either closed at 2R or 3R in profits, which means that this trade, or the move that I was expecting this trade, this setup to cause, has already happened. And I have an issue with that because I still haven't created any kind of consistent rule on which I can say, yes, when this amount of things happen, I'm going to completely avoid this price action, right? Or this entry. I'm going to remove the entry that I placed X amount of time or X amount of price action before. Now, in this case, what I have 100% sure is that if price moves enough for my target to be hit, I'm not going to be interested in participating on it. But here's the thing. I think I did mention it on the next screenshot. Yes. We have a 15-minute lower high here that if theoretically we're right about the direction, it should be broken, right? It's the next round of buys of liquidity that we could utilize for us to target, which means that price moves, doesn't get to the buy side liquidity, so the target is still intact. Reason why we could have taken this entry expecting price to actually continue going higher as it did right here, and then and after that target is hit, well, I don't know what could happen because that will be my target, right? So I ended up going back to the conclusion that this was a mistake to avoid, right? This is an entry that I could have easily taken, and at this point, even though price could get all the way up to this high, by executing on this level and targeting this high, we were getting 3.2 or 3.3 R or something like that. So it was more than enough for me to be pretty happy with that opportunity, right? So it was a lovely trade. Sadly, didn't know how to manage the situation, but I know for the future, in just in the case it actually does happen again. And as you can see, price pulls away much further away than that tiny bit of a high that I wanted to target, with a 0.5% risk as well. That happened on January 4th, and this is the first week of January. Well, obviously. We have the 5-minute time frame. We have a round of buys liquidity, right above those highs, and I think it barely takes this high as well. I don't really remember. I'm not sure why it's not shown. Goes aggressively lower, tiny bit of a fair value gap, fill right there. Goes aggressively lower, continues creating fair value gaps. Price trades inside of that, and that's when we jump onto the lower time frame. And we get price mitigated in the area. And as you can see, price actually went in a straight line to the upside. And the problem that I have with that type of price action is that I need a low, ideally to the left, to be broken, right? So in the structure that went higher. In this case, sorry, we don't really have that. So this would have been quite complicated at the beginning, but then we see price creating that tiny bit of a low that then is broken, but there's no parabolic gap. Then this happens, so it's another high being created, another low, higher low being created. This high being taken as liquidity, displacement, market shift, 1 minute for belly gap, and that's the execution. The 5 steps again, just in a little bit of a complicated manner in the 1 minute. After that, price goes somewhat in a pretty clear direction to the downside, right? But it does take some time. Ideal target would have been 2.54, which is what I was targeting at the beginning of this trade, but then I ended up closing to 2R because I was pretty happy with it, right? Final target would have been 3.97R because it's 4R basically, and we had the fact that the 50% of the Fibonacci on the most recent bullish impulse was there, so it was definitely a good looking target to go for, right? In this case, if I would have kept it going all the way down to this, I think it gets around 3R, but not 3 point something, probably 3R, 3 something R, and allowing price to go all the way up to drawdown and then come back down onto my take profit. I don't think I would have allowed for that to happen because we have 3R here 1 hour away from target, and price retracing all the way down up to my stop loss. Well, not my stop loss, my break-even point at this point. It would have been 100% a break-even, right? I don't think I would have finished this differently. I think that would have been a break-even, but again, closer to our, as far as I would have gone, would have been 2.5. So in this case, a pretty clear case on what I would have gotten out with a positive outcome one way or the other. 0.5% risk, GBP dollar short on Thursday, January 5th. Let's go over to that. And the higher time frame. Okay, I do remember this trade, on which, as you can see, the run liquidity happens here. A good amount of time happens until the market shift and the parabolic gap occurs, right? And when we go down into the 1 minute, the market shift and the step 4 and 5 is also a little bit complicated, right? Because this is the market shift. And when we already have a market shift, it's not that every single break of a low in this case is going to be another market shift, because at that point, the trend is already bearish. So we're getting breaks of structure. We're not getting market shifts anymore. And the step 4 is a market shift with a parabolic gap. We have a market shift and the parabolic gap is not there, right? So what happened here is that I counted this move higher as a market shift, although this is not a swing high, therefore this is not a market shift. So because of this mistake, this low is just a break of structure, so it's not a market shift. It does give us the parabolic gap, which is tiny, but overall a parabolic gap, so it is part of step 4. I considered this as a market shift, which it wasn't, and I executed right there. And as you can see, price went straight against me without any kind of hesitation, right? So the mistake here was not realizing that we basically didn't have the 5 steps, right? I think I did mention it, not the 5 steps maybe, so yeah, I do a little bit of an analysis then later. And that is pretty much it. A unnecessary loss, right? That could have been easily avoided, but nothing that I can do. Also, as you were able to see, the 5 minute was also quite messy. It doesn't happen as well as we would like it to. So definitely something to keep in mind. The last 2 trades that we have in front of us happen on the same day. We're going to be looking at another loss and then the win on euro dollar. And this one is also a little bit complicated. So let's see. We have the run sell liquidity, which is pretty clear. And the only problem here would have been the fact that this structure in the middle is created. This is what we look for, right? And this is how this trade happened. In this case, it doesn't really make that much difference, because even if we're counted this as the market shift, which ideally we don't, because this is what I consider internal structure, something that I want to make a video about. At the same time, the external or the structure to the left is being broken, right? Because this high, which is what I would have liked to use as a market shift, because it's a swing low, sorry, a lower low, lower high, lower low, right? Or maybe even this one, both of them are actually broken. So the fact that we're calling this a market shift doesn't really make that much of a difference on the fact that we took a loss. Now, this one is the loss that I consider valid about this one. About this day, the loss earlier, as you were able to see, was not based on the 5 steps, so it's definitely something to basically completely ignore. And the 1 minute time frame, in my opinion, did a pretty good job in giving us an entry with a pretty clear and aggressive move that causes the market shift and gives us the parabolic gap without any kind of an issue, right? So in my opinion, a valid loss. Could we avoided it because of this blueprint, right? The fact that it doesn't look like a blueprint, maybe, but there is a win that happened. So I'm recording this part on January 10th. There's a win that happened on January 9th on GBP dollar that had this exact structure just in the 15 minute, right? And it worked out wonderfully. So I don't really think that that minor change or alternative option on the step of the market shift really causes that on higher time frame market shift really causes that much of a difference. So I'm not gonna say that that was the deal breaker or the deal changer. With Thursday 5th January, 1.71 hour, and this one actually was closed prematurely, both due to the aggression that it had and because I had taken the 2 losses. So what I was looking for here was just covering those 2 losses and begin the next day with a clear spreadsheet per se. Let's look at how it went. We have a run of buys of liquidity above this couple of equal highs. I can actually zoom in. This couple of equal highs, and basically all of this couple of indications. Price trace above that. We see the displacement, the market shift right below that low, parabolic gap here, parabolic gap here, parabolic gap here. I didn't draw those because we didn't get lower time frame confluences. It actually gives one fake entry, second fake entry, and then the third happens at the higher parabolic gap. So it's basically a mitigation from scratch. And if we go down into the 1 minute, what we see is that on step 3, price starts going aggressively lower, causes the market shift. That's where I executed it, as I explained here, and comes back, mitigates the parabolic gap at the end, on which we would have had pretty much an even worse entry. Price goes aggressively lower, and in and around this level is where I closed the 1.71R, right? The 2R target was all the way down there, but to be fully honest, due to the news, I would have closed maybe 1 or 2 minutes before that, which means that the result would have been pretty much the same. I do not want to have a trade open through the news, as from 1 second to another, price could skip from here to above my loss, my stop loss, and make me take a 2R or a 3R or maybe even 4R loss in just one trade. Okay, now I will show you how many I missed out on, why I missed out on them, and how they happened. Continue to tell me which patterns repeat on all of this. Okay, so another thing worth noting is that all of these 5 things that you can see here are not up to date. And what I mean with that is that some of these wins happened quite a bit ago. It happened in between the time, as you can see, due to the dates, it happens in between the times on which I've been recording or journaling the trades on Trading Ball, right? Journaling the trades on this challenge trading. So I've been trading the challenge on this time, so they are considered missed opportunities. But just wanted to mention that they're a bit old. Let's start with GBP dollar, on which we could have taken 3.05R, and to keep in mind that, well, this one, yes, it would have actually been a 3% because of the fact that theoretically, this would have been the first trade on the challenge, and then I miss out on, then I take the loss, and that's when I started risking the 0.5%. But let's just jump into a trade. Let's look at the higher time frame. What do we have? Pretty clear round of buys of liquidity, right? Above a swing high. Aggressive move lower, which causes a market shift. A parabolic gap, price trace back into it. We go onto the 1 minute time frame. Price trace a little bit above that high. Not much displacement, and this is another one of those cases on which we don't really see the blueprint on a very clear manner. The higher time frame does have a clear blueprint, the lower time frame doesn't. But as you can see, it does end up causing the market shift down to this low and even this one. And the parabolic gap, sadly, post-market changed, but the way that it was drawn is the way that it was executed because there was a parabolic gap right there. I don't have a video about I have a video about it on the private community, but I'm not going to search up that. Just gonna have to trust me, or well, if you saw it live, then maybe you also have a memory of it. Beautiful trade. The 5 steps as they should happen. Reason why I ended up not taking it is because we had a major run on sell side liquidity. That's what I didn't like about it. So I decided not to trade it. And this is one of the reasons why I stopped using bias as well. The fact that we're in very discounted prices or very premium prices in some cases tend to not matter as much as I thought they used to, right? But let's move on to the next one. Another 3R trade. Do keep in mind that, as you were able to see on the previous one, we actually could have taken 4R instead of 3R, but 3R is as far as I'm going to be going. And this happened on Wednesday, December 28th. A 3R take profit on which the higher time frames do look like this. Run sell side liquidity, very tiny low, but is it a swing low? It is. Does price go below it? It does. Does price immediately cause an aggressive reaction, giving us displacement and a parabolic gap? It does. So run sell side liquidity, market shift, parabolic gap. We go down to the 1 minute. Price traces out of the parabolic gap. First reaction causes nothing. Goes aggressively lower. Oh, okay. First reaction is a little bit weak. This is not a swing high that we can use. Goes aggressively higher, causes a market shift, creates a parabolic gap. Execution could happen here with the stop loss below this low, due to the fact that this is a somewhat of a swing low, right? Somewhat, because it's a little bit complicated and could be argued that it's not. And just trusting that the low of the parabolic gap would have been respected, or all the way down there, which is the one that I personally would have liked to use. And this is the 3R trade that we can see penning out. This would have been difficult, but break-even should have been missed, because keep in mind that my break-even is around here, and even if price gets close to it, it has to trade 10 ticks or 12 ticks below it, as it is GBP dollar, right? Due to the spreads, has to trade a little bit below it. So nothing for me to do, really. Now let's move on to the next one, which is apparently 2 losses in a row. Because when I record missed losses, it's because of something. Run buys a liquidity, clear market shift, fair value gap. Nothing to say about that. Wait, what? Oh, this is a 15-minute time frame, okay. Price trades inside of that, run buys liquidity, pretty clear displacement, even this is a market shift, reason why we can execute on this one. And apparently price goes straight through our stop loss. Price reacts aggressively to this PI and later gave us buying opportunity. This is a way that we could have avoided this loss, but I understand that we got a buying opportunity, and the first 3 candles reacts quite aggressively. Still both sides have the 5 steps, so as if we're asked to do, being quite fully honest. So I do remember that this then turns around, mitigates this one, or maybe even this lower one, and continues going higher, which gives us the opportunity to be buying as well. I either missed out on that one as well, or decided not to trade it. Can't really say for sure because I don't remember. The thing is that partially true what I say, partially not really. I don't think that if we're going to be trading the 5 steps just because they're happening, then we should take both, right? So if we have this as a step 3, then I'm going to be looking for this market shift, right? And the execution of this fair value gap, as simple as that, with the stop loss, of course, all the way down there. That's the only thing that I can do, because the sell could have worked out just as the buy could have worked out. So I don't really think that there's any way that we could have actually avoided this loss. Personally, I missed out on it, right? Keep in mind that these are opportunities that I personally missed out on. I've missed out on other opportunities that I don't have in here. Oh, it's the buy that we were discussing earlier. Okay. So it's probably on the same day. Yep, same day. And this is the higher time frames from which we have run and sell liquidity, aggressive move higher, market shifts, fair value gap here, right? The price trades inside of here, gives us a loss probably, but this is outside of the kill zone. Goes back lower, doesn't trade inside of the fair value gap. Could have been used either way, right? It could have been used either way. To be fully honest, what I remember about this one is that I completely missed out on this fair value gap. So when I saw it causing the reaction, I realized that we had an entry on that fair value gap in the lower time frames, which is the one that we can see right here, right? The aggressive move higher, the market shift, the entry, and why is it drawn like that? I think it was drawn like that to get the minimum of 3R up to this, on which we would have been executed barely, right? An aggressive move, right? Like, still, now that I feel confident by going with 2.5R, the entry could have been higher, so still definitely a trigger one way or the other. Also, what I want to mention is that I don't see this as a mitigation, as price doesn't actually trade inside it. So that's one of the reasons why I kind of would have not looked for interest inside of this move. And at the same time, I didn't have a knowledge about this fair value gap, which made me potentially miss out on a take profit or an entry that just is not triggered due to the aggression on price. Now, what repeated on all of them? And I think it should be quite obvious, and it's the 5 steps. This is how I trade. This is what I've taught publicly on YouTube for weeks, maybe even months, on Telegram as well. Exactly. So what repeated on all of them? I think it should be quite obvious, but the 5 steps, right? This is exactly how I trade. This is what I taught through YouTube and Telegram publicly for a couple weeks, maybe even months. This is what I teach in my private community. Exactly the 5 same things traded over and over, day over day, week over week, month over month. And I don't think you need to ask the why, because it's quite obvious, right? It's because it's profitable for me. I don't think I need to tell you that, right? Now, of course, that doesn't necessarily mean that it will be profitable for everyone. And even though I do try my best to teach it, so with enough time and effort you can learn and maybe hypothetically profit from it on a demo account, some of you might never get it. This series of videos and what I do on my private community is exactly for that. I've found through ICT's concepts this way of trading that suits me very well. I'm pretty happy with it, right? And the profits are not little, and I'm pretty happy about that as well. So the reason behind my private community, and well, of course, this series of videos is exactly that. Just trying to show you how I do it on a daily basis, on a weekly basis, monthly basis, and just try to be a little bit more thorough on the explanations and see if I can help a couple of you do something with Forex in, of course, demo accounts. That's as far as I can go. So that's it. Let's see what I can do on part 2 and 3.